Welcome to Section 3 of the ASC 225 Income Statement Training for PNJ Group. Now that we understand gross profit, we turn to the costs of running the business itself, operating expenses. These are the period costs that sit between gross profit and operating income, and how we classify and present them tells a clear story about business efficiency. Let's work through each category and see how they connect. By the end of this section, you will be able to do 5 things. First, identify the 6 major categories of operating expenses recognized under US GAAP. Second, classify those expenses correctly using either function-based or nature-based presentation. Third, distinguish operating items from non-operating items, a distinction that matters for both analysis and compliance. Fourth, calculate operating income starting from gross profit. And fifth, apply the key ASC standards that govern when and how these expenses are recognized and presented. Think of operating expenses as the overhead of keeping the engine running, costs you incur to generate revenue that cannot be neatly tied to a single unit sold. Unlike cost of goods sold, which attaches directly to products, operating expenses are period costs. They land on the income statement in the period they are incurred, regardless of sales volume. US GAAP gives companies some flexibility in how they classify these costs, but that flexibility comes with a condition. Whatever approach you choose, you must apply it consistently and disclose it clearly. Selling expenses cover everything the company spends to get its product in front of customers and into their hands. Sales staff salaries and commissions belong here. So does advertising, whether that is a billboard, a digital campaign, or a trade show booth. Shipping and delivery costs to customers, trade promotions, and other customer incentives all fall into this bucket. The defining test is straightforward. If the cost is directly related to marketing or distributing the company's products, it belongs in selling expenses. General and administrative expenses, commonly called G&A, are the costs of running the entity itself. Not any particular product line or sales effort, but the organization as a whole. Executive compensation sits here. So does the corporate legal team, the accounting department, human resources, and IT infrastructure that does not qualify for capitalization. Office rent, utilities, and general insurance round out this category. If a cost keeps the lights on and the company functioning but does not tie to selling or producing a specific product, G&A is its home. Research and development is where the accounting gets interesting. The general rule under a SC 730 is straightforward. Expense R&D costs as they are incurred. Why? Because the future economic benefit is too uncertain to justify capitalizing the cost today. Think of it like buying a ticket before you know if the show will be any good. There is one important exception. Software development costs incurred after the product reaches technological feasibility can be capitalized. Before that threshold, they are expensed just like any other R&D. If R&D is material, it must be presented separately on the face of the income statement. Depreciation and amortization represent the systematic allocation of an asset's cost over its useful life. Depreciation applies to property, plant, and equipment under a SC 360. Amortization applies to finite life intangible assets under a SC 350. Here is what often surprises people. There is no single required line item for D&A on the income statement. It can be embedded in cost of goods sold, included within operating expenses, or broken out as a separate line, wherever it best reflects how the underlying asset is being used. Whatever approach is taken, best practice requires disclosing how much D&A falls into each category. Restructuring charges arise when a company exits a business activity or disposes of long-lived assets, things like employee severance, lease termination penalties, and write-downs of assets no longer in use. A SC 420 governs these costs, and the recognition rule is critical. You recognize the liability when it is incurred, not when management announces a restructuring plan. The announcement alone does not create a liability. If the amount is material, restructuring charges should appear as a separate line item on the face of the income statement or be fully disclosed in the notes. Any proposed restructuring charge should be escalated to your manager before recognition. Impairment losses arise when the carrying value of an asset exceeds what the company expects to recover from it. For goodwill and indefinite-lived intangibles, a SC 350 governs the assessment. For property, plant, and equipment, a SC 360 applies. Both standards require the impairment loss to be presented separately on the face of the income statement when material, not buried in a catch-all line. One US GAAP feature worth remembering: unlike IFRS, impairment losses on most assets cannot be reversed once recognized. That makes getting the initial assessment right especially important. There are two ways to organize operating expenses on the income statement. Function-based classification groups costs by what they do: cost of goods sold, selling expenses, G&A, R&D. This is the approach used by most U.S. public companies, and it produces subtotals that are highly useful for ratio analysis. Nature-based classification groups costs by what they are: raw materials, employee benefits, depreciation. This approach is more common under IFRS. Under ASC 220. Either method is acceptable as long as operating income is presented. The critical constraint is consistency. Once you choose an approach, you must stick with it. Any change requires retrospective restatement and clear disclosure. If a reclassification is proposed, escalate it to your manager. Operating income is the destination we have been building toward. The formula is simple: gross profit minus total operating expenses. It is also called income from operations, or EBIT, earnings before interest and taxes. A SC 220-1040-51 requires this subtotal to be presented on the face of the income statement or disclosed in the notes. Because it excludes financing costs and taxes, items that vary based on capital structure and tax jurisdiction rather than operations, operating income is the number analysts rely on most when comparing companies across industries. It answers a clean question: how well does this business run its core operations? Let us pull the key points together. Operating expenses are period costs that cannot be directly assigned to specific units sold, and US GAAP requires consistent classification and disclosure. R&D is expensed as incurred under a SC 730, with a narrow exception for software costs after technological feasibility. Restructuring charges under a SC 420 are recognized when the liability is incurred, not when a plan is announced, and any proposed charge should be escalated to your manager. Depreciation and amortization can appear in COGS or operating expenses, but the amounts in each category should be disclosed. And operating income, gross profit minus operating expenses, is the subtotal that a SC 220-1040-51 requires and that analysts depend on for cross-company comparisons. Thank you for completing this section on operating expenses and operating income.